If you are 60 or older and you filed your taxes this year without checking 3 specific things, there's a real chance the IRS is holding money that belongs to you. Not a small amount. We are talking about hundreds, sometimes thousands of dollars. And the deadline to claim it is not as far away as you think. This is not a scare tactic. This is not fine print. This is a straightforward walkthrough of the rules that apply specifically to people in retirement. Rules that are different from what working adults deal with, and rules that most tax software does not explain clearly. By the time this script is done, you will know exactly what to look for, what forms matter, and what to do if you think you were underpaid or overcharged. Let's get into it. Why seniors are in a different tax situation than everyone else. Most tax advice online is written for people who have a job and a W-2. That is not your situation if you are drawing Social Security, a pension, or pulling from a retirement account. The rules for your income are genuinely different, and the IRS does not go out of its way to explain those differences in plain English. Here's the first thing you need to understand. Not all of your Social Security income is taxable. Depending on your total income from all sources, somewhere between 0% and 85% of your Social Security benefit gets added to your taxable income. The rest is not touched. That means if your tax preparer or your software is not calculating this correctly, you may have paid taxes on money that should have been exempt. The formula works like this. The IRS looks at something called your combined income, that is your adjusted gross income, plus any non-taxable interest you earned, plus half of your Social Security benefit for the year. If that combined number is below $25,000 for a single filer, or below $32,000 for a married couple filing jointly, none of your Social Security is taxable at all. 0. If it falls between $25,000 and $34,000 for a single person, up to half of your benefit may be taxable. Above $34,000, up to 85% can be taxed. Notice the word up to. That matters. The IRS does not automatically take the maximum. The actual percentage depends on your specific numbers. If a tax preparer just assumed the maximum without running the actual calculation, you may have overpaid. If you use software and entered your income incorrectly, same result. This is the first place to check. Pull out your most recent tax return. Look at line 6B on Form 1040. That is the line where your taxable Social Security amount appears. Then look at what you actually received in Social Security for that year. You can find this on your SSA-1099, which Social Security mails to you every January. If line 6B shows the full amount you received and your combined income is not well above $34,000, something may have gone wrong. The standard deduction. That many seniors are not taking in full here is something that does not get talked about enough. If you are 65 or older, the IRS gives you a higher standard deduction than younger filers get. This is not a loophole. It is written directly into the tax code. But if you or your preparer are not applying it correctly, you are leaving money on the table. For the 2025 tax year, the return most people filed in early 2026, the basic standard deduction for a single filer was $15,000. But if you are 65 or older, you get an additional $2,000 on top of that. That brings your standard deduction to $17,000 if you are single and 65 or older. If you are married and both spouses are 65 or older, each of you gets that extra amount. The combined standard deduction for a married couple, both over 65, was $32,300 for the 2025 tax year. If one spouse is 65 or older and the other is not, you still get the extra deduction for the qualifying spouse. This matters because every dollar of standard deduction reduces your taxable income by $1. If you were given the regular deduction instead of the senior deduction, you paid taxes on income that should have been shielded. Pull out your 1040 again. Look at line 12. That is where your standard deduction appears. If you took the standard deduction and the number does not match what you should have received based on your age and filing status, that is a red flag. The fix, if you catch an error from a prior year, is to file an amended return using Form 1040-X. You generally have 3 years from the original filing deadline to do this. That means if you overpaid on your 2022 return, your window to amend it is still open. Same for 2023 and 2024. If you want to make sure you are not missing anything like this going forward, the best thing you can do right now is share this with someone in your household or your family. Not because we need views, but because 2 sets of eyes on a tax return catch more than one. Pass this along. The credit for the elderly or disabled, and why almost nobody claims it. There is a tax credit called the credit for the elderly or the disabled. It is on Schedule R, and the number of people who qualify for it and do not claim it is genuinely frustrating. This credit is for people who are 65 or older, or who are permanently and totally disabled and retired on disability. It is also income limited, which is why it applies mainly to people with modest retirement income rather than high earners. But if you qualify, it directly reduces the taxes you owe, not just your taxable income, but the actual tax bill. The credit amount depends on your filing status and income. The base amounts the IRS uses are $5,000 for single filers, $7,500 for married couples filing jointly where both qualify, and $3,750 if you are married, filing jointly but only one spouse qualifies. From those base amounts, the IRS subtracts your non-taxable Social Security and pension income and then reduces the remainder by a formula tied to your adjusted gross income. The resulting credit can be as high as $1,125 for a single filer. That is not a fortune, but it is real money, and most tax software does not prominently flag this credit or walk seniors through it clearly. Many preparers skip it because the income limits make them assume the client will not qualify without actually checking. To see if you might qualify, you need a few numbers: your total adjusted gross income, your total non-taxable Social Security income for the year, your total non-taxable pension or disability income. If after subtracting those amounts from the base figure there is still a positive number remaining, you may have a credit available. The income phase-out starts at $17,500 for single filers and $25,000 for married couples filing jointly. If your adjusted gross income is above those numbers, the credit phases out. But if you are below them, this is worth investigating. If you think you may have missed this credit in a prior year, Form 104-0-X with Schedule R is the path forward. What happened with RMDs and the IRS rules around them. If you have a traditional IRA or a 401k, you are required by law to start taking money out of those accounts once you reach a certain age. These are called Required Minimum Distributions, or RMDs. The rules around RMDs have changed significantly in the past few years, and some people are still filing under the old rules without realizing it. Here's where things stand as of 2026. The Secure 2.0 Act, which passed in late 2022, pushed the age at which RMDs must begin. If you were born in 1951 or later, your required starting age is 73. If you were born in 1959 or later, your required starting age is actually 75, though there was a brief period of confusion in the law about the exact cutoff, and the IRS issued guidance to clarify it. Why does this matter for a potential refund? Two reasons. First, if you took money out of a retirement account thinking you were required to, but you actually were not, you may have paid taxes on a withdrawal you did not need to make. The IRS cannot reverse that on its own. You made the withdrawal, but understanding your actual RMD start date going forward can help you plan better and keep more money in your accounts longer, where it grows tax deferred. Second, some people who should have been taking RMDs missed them, got hit with a penalty, and paid it. The RMD penalty used to be 50% of the amount you should have withdrawn. Secure 2.0 dropped that to 25%, and in some cases down to 10% if you fix the mistake in a timely way. If you paid a penalty under the old 50% rate and you were within the correction window, there may be grounds to request relief. For questions about RMD penalty relief, the IRS has a formal process. You can contact the IRS directly at 1-800-291-040. That is the main individual taxpayer line. You can also work with a tax professional or a certified public accountant to file for a waiver using Form 5329. The IRMAA situation, when higher income costs you more for Medicare. This one is specifically for people whose income went up significantly in a prior year, maybe from a one-time event like selling a house, taking a large IRA distribution, or receiving an inheritance, and then came back down. Medicare. Part B and Part D premiums are income tested. The standard Part B premium in 2026 is $185 per month, but if your income from 2 years ago was above certain thresholds, you are being charged more. The SSA looks at your tax return from 2 years prior to set your Medicare premium. This extra charge is called IRMAA, Income-Related Monthly Adjustment Amount. It is not a penalty in the traditional sense. It is just how Medicare pricing works for higher earners. But if your income dropped significantly after the year the SSA used to calculate your premium, you may be paying more than you should be right now. Here's the important part. You can appeal. The SSA has a formal process called a life-changing event appeal. If your income dropped because of retirement, divorce, death of a spouse, or a reduction in work hours, you can ask the SSA to use a more recent tax year when calculating your premium. This is done using Form SSA 44. If your appeal is successful and your premium is reduced, you may also be entitled to a refund of the extra amount you already paid. This is not automatic, you have to request it, but it is real money. Depending on your income bracket, the IRMAA surcharge can be anywhere from $74 to over $400 per month per person. If you have been overpaying for several months, that adds up fast. To get started on this, call the Social Security Administration at 1-800-772-1213. Tell them you want to appeal your IRMAA determination and ask about Form SSA 44. They can walk you through what documentation you need, which typically includes proof of the income change and a copy of a more recent tax return. Before we go further, if you are finding this useful and you are not yet subscribed to this channel, now is a good time. These rules change, the thresholds change, the forms change. Subscribing with notifications on means you hear about updates when they happen, not months later. The pension and annuity withholding problem. If you receive a pension or annuity, the company or fund paying you should have sent you a form at the start of your retirement asking how much federal tax you want withheld. That form is called W-4P. Many people either filled it out years ago and never updated it, or chose to have no withholding because they thought their income would be too low to owe taxes. If your situation changed, if you started collecting Social Security on top of your pension, or if you started taking IRA distributions, your total income may now be high enough that you owe taxes, but your withholding may still be set to zero or a very low amount. This can create two opposite problems. If you underwithheld, you may owe the IRS money at tax time, plus a possible underpayment penalty. If you overwithheld, maybe because you set a high withholding rate early in retirement when you were worried about taxes and your situation has since changed, you may have a refund coming. The fix in either direction is to update your W-4P with your pension administrator. You can also file quarterly estimated taxes using Form 104 O-ES if you want more control over what you pay and when, rather than letting withholding do all the work. If you overpaid through withholding and filed your return correctly, your refund should have been issued automatically. If you believe you overpaid but never received a refund, the IRS Where's My Refund tool at irs.gov can tell you the status. You will need your Social Security number, filing status, and the exact refund amount from your return. What to do if you have not filed in several years? Some people stop filing taxes in retirement because they assume their income is too low to require it. Sometimes that is correct, sometimes it is not. And if you had taxable income and did not file, the IRS may have filed a return on your behalf using a process called a substitute for return, which typically uses the least favorable assumptions possible. More importantly, if you had refundable credits coming to you, like the Earned Income Tax Credit, which some seniors with modest earned income can still qualify for, and you did not file, you cannot collect that refund without filing. And the window to claim a refund from a past year is 3 years from the original due date of that return. That means, right now, in 2026, you can still file and claim refunds for tax years 2022, 2023, and 2024. After April 15th, 2026, the window for 2022 closes permanently. If you have unfiled returns from those years and you think you may have been owed a refund, the time to act is now. You can file late returns the same way you would file on time, using Form 104O for each year. If you need prior year tax documents like W-2s or 1099s, the IRS can send transcripts of what was reported to them using Form 4 506-T. That is a free service. A word on choosing the right. Help. Not all tax help is equal. There are paid preparers who are excellent. There are paid preparers who rush through senior returns without checking for the specific deductions and credits that apply. There are also free options specifically designed for seniors. The IRS runs 2 free programs worth knowing about. The first is called VITA, Volunteer Income Tax Assistance. It is aimed at people with income generally below $67,000. The second is called TCE, Tax Counseling for the Elderly. It is specifically for people 60 and older, and the volunteers are trained in retirement-related tax issues, Social Security income, pension income, RMDs, and the senior deductions we discussed. Both programs are staffed by IRS-certified volunteers. You can find a VITA or TCE site near you by searching the IRS website at irs.gov or by calling 1-8009-069-887. AARP also operates tax aid sites through TCE. You do not need to be an AARP member to use this service. They operate at thousands of locations and can also help remotely in many areas. The 3 steps to take this week. Here is the short version of everything we covered, turned into action. Step 1. Pull out your most recent tax return and your SSA-1099. Check line 6B on your 104.0 to see how much of your Social Security was counted as taxable. Compare it to your actual benefit and your combined income. If something looks off, consult a tax professional or a TCE volunteer. Step 2. Confirm your standard deduction on line 12 of your 104.0 includes the senior edition if you were 65 or older for the tax year in question. If it does not, and you took the standard deduction rather than itemizing, you may have a valid amended return. Step 3. If you are on Medicare and your premiums went up due to higher income in a prior year and your income has since come down, call the SSA at 1-800-772-1213 and ask about Form SSA 44 to appeal your IRMAA determination. None of this requires an expensive attorney or a complicated process. It requires a little time, the right forms, and knowing where to look. The IRS is not hiding this money from you on purpose, but it is also not sending you a letter that says, "Hey, we think you overpaid." That letter does not exist. The responsibility to check is yours. A final note. The rules around retirement income are genuinely complicated, and they change more often than most people realize. This year's thresholds are different from last year's. Next year's will likely be different again. The best thing you can do, for yourself and for people close to you, is stay informed and stay organized. Keep your tax returns. Keep your SSA-1099s. Keep your Medicare statements. These documents are the raw material for catching mistakes, filing amendments, and making sure you are not paying more than the law requires. If you have questions about your specific situation, a tax professional who specializes in retirement income is worth the cost of a single appointment. So is a free session with a TCE volunteer. The money you might recover could easily exceed what you spend to find it. Take the time, check the numbers. The refund, if there is one, belongs to you.